Nitin Rakesh, MD and CEO of Motilal Oswal Asset Management, joins us on the show now. Nitin, thanks so much for joining in. You know, since you're sitting at that place, let me just ask you, after the massive liquidity injected into the Indian markets in 2010, it is fairly tepid in the first half. You must have been talking to a lot of funds in Europe as well. Would funds look to buy more into Indian equities in the second half of 2011?
I think you're absolutely right. You know, we had a pretty massive inflow in the markets last year, almost $40 billion if we include all the IPOs and the government company stock that came out. Compared to that, we've actually had a flat year this year, at least till the last week. So I think actually a lot of people are surprised that we haven't seen any outflow of capital from India, given that the market has actually been underperforming and was perceived to be an expensive market early this year. So I think that just shows that the longer term story and the investor confidence in the long term story stays. Whether we get inflows in the second half of this year depends on a lot of things that are going on in the markets right now. But I think we do expect the markets to start looking much more cheaper, because earnings momentum is still fairly intact in the high teens. So I think it's really a question of what happens globally. But I definitely think second half might be better than the first half.
Right, Nitin, BRIC nations, where does India stand given the consensus underweight that it has?
Again, I think there are two or three countervailing forces at play here. Clearly, when you look at valuations on paper, India looks like it's a little expensive compared to other markets. But again, if you see the earnings growth that we are projecting for this year, which is around 19%, next year around 21%. So clearly, we're still looking at 18-20% earnings growth over the next couple of years. From that perspective, we are definitely below our 15-year averages on price earnings at about 14 times current year. So clearly, valuation-wise, people have used that really as an argument to stay underweight in India, and this year so far it's worked for them. But I think, as I said, it's really India is really a good way to play the global slowdown as a hedge, because, as I said, if global commodity prices, oil prices start cooling off, which they have been doing, then I think we're really one of the best investment stories amongst the BRIC pack.
Inflationary pressures, Nitin, loom large for emerging markets, particularly India. While the RBI may have raised 25 basis points for the last so many meets, do you foresee that these moves could continue for a prolonged period?
I don't think so. I think in the long run, people tend to kind of look at each individual market's fortunes in isolation. Yes, capital flows and risk capital and risk appetite is joined at the hip. But I think that's a much more shorter term, next 1 to 3 month criteria. Unless obviously we go into a situation that the contagion spreads far more than just 1 or 2 nations.
Nitin, inflationary pressures loom large for emerging markets, particularly India. While the RBI has raised rates by 25 basis points, do you foresee a similar move by the Central Bank of India going forward as well?
I think in the next round, potentially yes, another 25 basis points, and then I think we may have to review what's happening with global commodities, because, as you know, India is one of those counter-cyclical plays. When global commodity cycle turns downwards is when actually the fortunes for our companies likely to turn upwards. So I think inflation pressure should ease off if commodity prices continue to cool off globally, especially oil. And so I think it's really a question of what happens globally. If QE3 doesn't come by, which looks that likely going to be the case, then I think we may not actually see we may not see many more rounds. So we are really at the fag end of our tightening cycle right now.
Nitin, given the current interest rate scenario, then, since we're speaking about that, are rate sensitives a sector that you would dabble with?
I think rate sensitives, you can really divide them into 2 or 3 categories. So if you look at things like banks, I think banking is a good place to be in, even though we've seen some short-term concerns. But private sector banks or some of the larger names that have a strong liability franchise are potentially great places to be in and to buy into the fall. If you look at other rate-sensitive sectors like automobiles, which have a certain consumption tied into the rate sensitives, I think two-wheelers you can pretty much be comfortable with. Four-wheelers potentially may want to see the impact of rate cycle play out. And then you have the other aspect of sectors like real estate and construction, and investment infrastructure, which I think at this point is best being underweight till we see the cycle turn around.
Consumption-based stocks, how are you viewing the consumption-based sector at this point of time? It's been fairly active. Do you see a potential upside from these levels?
Well, I think over the last 2 quarters, especially last 3 months, there's been a flight to safety, and the one thing that hasn't been impacted so far in India is the core consumption across things like consumer staples, consumer discretionary, specifically the lower end of the market. So two-wheelers, telecom, all of that's been growing very robustly, and I think that's likely to continue because even though we've had some slowdown, in the higher end items like four-wheelers, I think, or real estate, I think the core consumption story is still very much intact. Wage inflation, which at about 10-12%, has pretty much kept up pace with core inflation, and hence there hasn't been a slowdown in spending, even though we may have seen a 1 or 2 percentage points slip up in final consumption. But I think consumption story really is one of the best places to be in India until such time that we see an interest rate cycle turning around. I think we might see some interest in investment cycle post that, but so far it's all about consumption.
Nitin, given the volatility in crude oil prices, how are you playing the commodity-related sectors? I mean, I'm particularly talking about oil and gas.
Well, that's a tough one to call. Again, if you see the Indian oil and gas companies, I mean, there are two types again. There's exploration and there's oil marketing. I think we are a little more bullish on the oil marketing side of the business because I think that's where you will see margins correct themselves if the oil prices continue to kind of stay soft, which really is our call right now. So on the exploration side, I think it's a little different game, and that's really only 1 or 2 players that you have there, which is Reliance and ONGC. I think that's a lot more tougher to call right now, given the challenges we've seen on the gas front. But I think on the OMCs, it's a good contra play, and I think if you take a bet on softening of oil prices, these companies will stand to benefit.